Good evening. This is the Eye of the Storm podcast for the 30-year bond, the 10-year note, the 5-year note, and the 2-year note, gold and silver, and the dollar index. For January the 1st, 2023, and this is part 2 of my year-end big picture update. I'm going to start here with the 30-year bond, but I want to bring back in, it's like if you didn't happen to listen to the update, which included the SPX and the NDX, then you also didn't hear what I was speaking to with regard to inflation. So just to kind of do a quick overview of that for those that did actually listen to the podcast yesterday. What I think remains of importance moving forward, particularly as we move through this particular winter, and then, of course, as the years roll out, is what is happening in Europe as far as their energy crisis is in Europe. We can't forget that Russian oil got shut off, Russian gas got shut off, and then the pipeline was sabotaged, was damaged, and so the pipeline has been shut down. So Western Europe is in a pretty big bind to find the energy, to find the gas, the natural gas, to heat all of Europe. And so Europe thus far has gotten together with has put together about a $1 trillion energy bill just to get all of those countries through this particular winter. And as many of you know or don't know, I did live in the Netherlands for 10 years. And during that time, utilities of gas and electricity were state-owned. They were owned by the individual countries. That now has all gone into privatization. And that privatization, basically is going to then control who gets what. And they're doing it for profit. And so they paid the government a great deal of money. This is also going on in the United States, where we're seeing, already have seen, but more of private equity firms, or some even go under venture capital type firms, are buying large stakes in utility companies. And so it could become a problem here. And what I mean by that is that in Europe, the cost is so repressive right now that the governments of the individual countries, as well as the European Union, have to come up with some type of a plan who's going to subsidize what and how quickly that can come together. So again, to relate it back to the inflation conversation, that even though we have a Federal Reserve that is discussing that, hey, look, we're making progress, we're going to keep the good fight, but we're seeing some improvements in the inflation front. We're seeing some shrinkage there via the CPI, et cetera, et cetera. And these are not totally fibs, but they're much fabricated in the way that they're kind of contorted, they're kind of put together to reflect what they reflect, when in actuality it's kind of like smoke and mirrors. So what we really have going on is that inflation, we're being told, is we're fighting to get it back under control, but we're making progress. And so they show the different things in terms of we had much higher inflation when crude oil was being priced at 110, 120, as high as $130, and was remaining above 100 for a pretty extended period of time. And therefore, we went into here in the state of California, where gas was over $6 a gallon, and in some parts of the state, well over $7 a gallon. And so that's very inflationary. So when crude oil drops, suddenly, they're showing us that inflation is slowing or getting better. But in order for that to continue, they can't subsidize, crude. The fact is that the utilities, gas, oil, fluctuate accordingly, supply and demand. So why we think we're getting a grip on inflation, or why we think that the Fed is doing it, and the job that they're doing by raising interest rates is really not having an effect, that's the misnomer. They're not. They're not. The food prices continue to go up and up and up and up and up. And control over the utilities is putting a squeeze on us here in the United States as we watch the price of gas get higher, as we see the utility companies put in for increases in natural gas for the gas prices and for the electrical prices to continue to fund different things in that company. Particularly here in Northern California, we have a utility company that really had to take responsibility for a lot of the fires that created billions and billions of dollars worth of damage to communities, burned entire cities that no longer exist, killed many people. And they had to take responsibility for basically having faulty equipment, unkept equipment, and then they were, had to come up with a settlement and a price. Well, somehow the Public Utilities Commission of the state of California has decided that, well, the customers of PG&E should have to pay for that. And I was always very interested. It's like we didn't have any part of why they didn't keep up with their upkeep on their equipment, on the lines, et cetera, et cetera, et cetera. So in any case, these things are now still filtering through. I just received notice of the energy prices in my area of the state. So in San Francisco, they're going to be raising both electrical and gas several times next year, or 2023 this year. That is not bringing inflation back in line. That is adding to the inflation, and it adds to it in a big way because each one of us that have a home, live in a home, have responsibility for utilities, guess what? It affects every last one of us. And those that have, no problem, they can handle it. Those that don't, it becomes a burden. And so more control goes over to those utility companies because suddenly people's utilities are being cut off. Then we're going to get subsidies, et cetera, et cetera. So this inflation problem isn't just going to go away. And in Europe, the global gas markets, they're not finding that there's going to be any time soon that's going to get some relief in terms of that the supply and demand is going to be met because we're going to have more supply versus that we're boosting the prices. So, in other words, so they're not expecting anything on that level until 2026. And a great part of that is because I don't believe that they have started to actually repair the pipeline. And so, and I believe when they had the problem that I read that it would take several years to repair it because it lies at the bottom of the North Sea. Not the North Sea, but of the Baltic. Somewhere up there in Scandinavia. In any case, inflation is real. It's not intending to really go down. So the answer to inflation, to get it under control, is to start to take money out of other people's control. If we don't have the money to spend, the prices can't really keep going up, but they can in terms of like a utility or something like that. So the inflation can continue to get squeezed and we'll have less money. So there's some real danger here. So they're going to have to get interest rates up high enough where even a utility company or even anybody is going to have problems trying to qualify for a loan, and so that we can start to see prices come back down the other way. We can start to see the interest rates then begin to come back into line. We can see the production. We can see that people are going to be able to pay their bills and still have money. So, et cetera, et cetera. So this whole scale is way out of line. And what that's going to do to the bond market is going to be pretty much in line with what we've just seen. Now, yes, I agree. There are differences between the 1970s to 80s and to 2020 to 2022. But remember, as I said before, the US debt to GDP, that ratio in the 70s to 80s, that ranged between 31 to 35%. Today, and just covering a 2-year period, it's at 121%. So let's say in 2020, prior to the pandemic, maybe we were at 50, maybe we were at 75%. I don't know. I'd have to go back and look. But we were not close to 121. But there we sit. Now, and primarily because the national debt has ballooned twice now, right? We've already talked about 2008, 2009. What came after that was a bailout of corporate. That financial meltdown, which basically looks like nothing on a chart compared to the rise that we've just done. But in any case, that meltdown destroyed a lot of capital. And that capital had to be churned out, reinstituted, and put back into the system via stimulus. And that was done by the government, the Federal Reserve, and the Treasury Department. And now we have $31.4 trillion in debt. That's not including likely the 1.7 that got passed so that the government can fund itself for another year, et cetera, et cetera. So when we want to talk about inflation's abating, and when we want to talk about inflation, yeah, it's all under control now because so-and-so said so on CNBC, or so-and-so said so on another financial media. And that grabs a hold of the pundits, because don't forget that in order to get us engaged, in order to get people just to start tossing and keep tossing their money into this funnel, that they have to be fed something a little bit more positive than interest rates are continuing to go up, so the prices are going to go down. Well, we've got a grip on that inflation. We might see a little bit more into the blah, 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 but you're in it for the long term, et cetera, et cetera, et cetera. Now, I want to go over and I want to start talking about these bonds. Here is the all-time high for the 30-year bond in terms of the price of the bond. And I believe that was in March of 2020. The bond reached 192 in price. Tremendous. I think it was kind of like just like this, and this is a monthly. So it was like a fat finger exercise, and boom, it came all the way back down. So, but in any case, the price high for the bond is marked at 192.15. The low for the yield is 1.17, and that would have been in March, I think it was. Oh no, excuse me, in August of 2020. That's when the bond reached its yield low. So the bond was yielding 1.17%. And now, as of December the 30th, so last Friday, this bond yield closed at 3.97%. So it's very close to that 4%. And this is going to be interesting because I want you to remember 4%. Because on the long end of the curve, I've been talking about how the markets have basically all put in 5 waves down off of their bond highs. The bond price high, not the yield, the bond price high. So they all reached those, and from that level have put 5 waves down. Now, as far as a yield chart, they've gone from their all-time lows up to current levels by also putting in 5 waves up. All right, so if we're counting it as 5 waves down from that level, 1, 2, 3, 4, 1, 2, 3, 4, 5. So I can count it as 5 waves down. That puts us in an ABC corrective pattern. We can start building the case for where we believe these things should start to come. Now, so first thing I'm going to do, I'm going to put, now again, this is going to be for price, bond price, not yield. So what we were thinking, and I continue to think, because I've seen, and I'm going to go down to the weekly chart because I'm going to be able to see this a little bit cleaner. Same deal, 5 down. We should get 3 up. Now, understand that 5 down, as far as an Elliott wave total movement, complete movement, 5 waves down or 5 waves up. So in other words, all by itself, just being a 5-wave structure, is never the complete structure. There often will be an additional, in this case, we did 5 waves down, we'll get 3 waves up, followed by an additional 5 waves down. That will be a complete movement. So, and it would be corrective in terms of now we're ready to go and start another long-term, right? So multiple months, multiple years of a rally back up and bond price and dropping for yield. Now, price for price and situation to situation, we're also told that there are a lot of differences between the 1970s to 1980 or even 1981 and 2022, now going into 2023. And that's true. It's gotten worse. It's gotten bigger. There's way, way more money involved than there was in 1981. So that's the first thing. So when we're talking inflation, we're talking about the injection of all that stimulus money is what is creating the inflation. So if we don't stop that and pull the money back in, interest rates will continue to go up. They need to, because there's too much out there needs to be reeled in. So, having said that, it needs to be corrected. That's what we're doing. We've got the first leg. I'll go up to a cycle degree. We've got a cycle degree A wave, let's call it. Or I even call it a primary degree A wave. And that took from 2020 to 2022 to get done. Now we're in that B wave. It projects as a minimum to get up to 135. That's only 0.236. 382, so in other words, a 382 or 38% retracement of the decline brings the bond price back to the 146 area. Are these possible? Yes, they are, and they would be very normal under an Elliott basis. Now, being that it's a bond that isn't, very interest rate sensitive, and we're in a period of a lot of volatility in interest rates connected to inflation, connected to corrections, connected, et cetera, et cetera, et cetera. When everything lines up, it should still produce the same emotional responses that we're getting. But the degree as to what level it should get to, I think will also differ because of the amount that actually is out there that would get destroyed. It could destroy a lot. For example, that we have 30-year bonds that that the money was borrowed at 1.17%. And the price of the bond itself could be dropping massively. And so who's ever holding that 1.17, they're going to be out because they're losing way more than they're receiving in terms of the coupon. So they're going to sell it back to the government. And we got to pay our bills as a government, as the issuer. You got to pay your bills. and that's going to be sticky. So all that stickiness, as to what level will the binds ultimately get to? Well, if I'm looking for 38% retracement and then an additional drop, I can just give a very broad stroke, very, very broad stroke by saying, well, we'd be looking for a C wave, and what we have to compare against would be that A wave, and we're going to call that the B wave gets us up to there. Well, we're looking at bond prices maybe 71 or lower, and C waves can come in lower. Will they get down to 50? I don't know. There's a lot of talk out there for some very, very severe things to be coming down the pike. But 71, yeah, why not? And I'll tell you, so what is that going to be equal to? At 117, we're approximately 4%, or nah, probably a little bit over 4+%. And if we dropped an additional, wow, there you go, 40, what's that going to do? It's going to really push these. Are we going to be at 5, 7, 8? So, and we're talking about the long bond being back at 7 to 8%. What interest rates will then actually be will be through the roof. So yeah, I think we're going to have to be prepared. Now, shorter term, let me take away those because we're still looking at the ABC. So within that, going back down to that weekly chart, I think I can almost count this as a 1, 2, 3, 4, 5. So already in my mind, I'm going, if we're going to get an ABC, it should be a 5, 3, 5. We should get a zigzag. Right? And I'll give you the alternate on this. The alternate on this is that it is a complete ABC, right? A, B, and then a 5-wave C. And if that's the case, we're going now. And this would be so weak against all of that. It either suggests that we dropped to 5% and then somehow this extended one more time that I need to fit in. So we could drop to 5.5% now and then still rally later. So there's choices here that the market needs to let us know. But right now, I'm looking at this as like an A, and this is a B. So now I can put one more, I'm going to go back over, and I'm now going to go to the retracements because I want to see what a B wave can look like. Again, I'm on a weekly chart. So let me take it down to the daily where I can take a look at more inside to what we got going on. And we're looking for a B wave. And right now it's come to over 50%. That's pretty common. That's very common for a B wave. To come in at 50% of the A wave? Sure. 618 is also in there, and that's 123. Can it drop to 123? Absolutely. We were down closer to 124 last week or on Friday. So to get to 123, that's just another point down. And then put in another 5 waves up. And that then takes us back. But right now, we're looking for a completion of this internal B wave of a larger ABC, which I believe will be a zigzag. So we still have on a daily basis, the daily 200 at 134.16. Then we have 0.236 at 135.13. I think the C wave up should exceed 135 and get itself closer to 146. Now, again, this A wave took from the end of October until the beginning or the middle of December. So it's about 2 months. And then if we can get this B wave done, that's the middle of December to the end of December, 2 weeks. So if we get another 2-month rally, takes us into obviously 2023 here, out towards March. Is that possible? Yeah, it is. A lot of other things can happen. And we can try and tie this in to the equity markets or the equity indexes and to gold and silver, but it's really going to fall on interest rates themselves, of course. And it's going to be what the government's going to be forced or not forced to kind of come out and start to do. This would be that rates stabilize and actually we get more of a little bit of an easing, but they still do maybe 50, 50, 50, whatever they want to do. But we get a little bit of an easing on the speed at which they're raising them. You know, how much, the amount. And then, you know, and this also, by the way, I'm looking for a completion of the primary C wave, but the completion of a cycle A wave and then a cycle B wave. Part of that cycle B wave could come in on the heels of the interest rate markets doing a rebound. In other words, the price of the bonds go up, the yields go down, and it's nothing more than a counter trend rally for right now. All right, so now I'm going to back over. And again, go back out to that monthly chart. So we can see that on December 30th, 3.97 to almost 4. Where can we go from here? Maybe we tack a little bit more on, get back on this side of 4. 4 plus before we turn and maybe put a little bit of additional rally. Going down to the 10-year note. We have pretty much the same story, just a little bit different. On last Friday, the 10-year note closed at 3.88. So and I got this is a little bit wrong. Let me go fix that right away. Edit the properties, and it's 3.88. Sorry about that. That was playing music. No, I'm not. 88. And say okay. All right. And so I'm sorry about that. Let's get rid of it. There you go. 3.80 at the close on Friday. 10-year note saw some decent volume. 10-year note saw some pretty strong movement. So for the month, down bar. But again, A, B, we get a C. No, 3.88 so far. And again, the range has kind of been that I was looking at was 3.5 upside, 4 downside. And I felt that it was probably a pretty good bet to go ahead and sell 3.5 and buy 4. And what I mean by that is you're selling the 10-year note at that 3.5 level and you're buying it down here. So you're shorting it, you're buying it, you made some good money. Now, again, we may still have a little bit more to go before we actually turn this whole thing. But here I look again and I say, wow, 1, 2, 3, 4, 5. Looks good to me to be an A wave. Can it be an ABC? It can be. If it is, get out of the pool, right? There's a tsunami coming, basically, because that's a pretty strong decline. And again, what it could be telling us is that we can come all the way down here and call this 1, 2. That's only 3. This is a 4, if that's all we got. And we come down in a 5 and maybe reach a low, 107-ish or whatever, and then put this larger, a little bit larger rally in. And again, that may come next year. So they're looking for a lot of things midway through 2023 or between the first and second quarter. So this could be one. And as I said, in the 30-year carries into the 10, also down to the 5 and the 2. We could continue to move lower, but instead of it showing total weakness and just dropping out of the sky, it may just come down a little bit. Now, what can I do initially? I can, let me just draw and use these. And we're going to be talking about if it's just indeed, we're going to come down and go back up And I want to look at what a little fifth wave could be. So we're going to go from here to here to here. And we're looking, well, you can see if indeed this is a 1, 2, 3, 4, and now we're going to do a 5. 382s brings us down to 105. 50 brings us down to 101. That's down there. And I do see that coming later, but for it to happen now, takes this and pushes it up past like 4.5 to 5. On the 10-year note, 4.5 to 5, maybe even above, before we get that rally. Now, I'm going to take that off. And because we've got these for what we have. If this indeed is an A, and now we're putting in the B wave, I already have that. I want to go back over to, come on, those, and I want to bring this up from here. Come on. Second. Yep. There to there. We're just looking for retracements for B wave, and I'm going to bring this back down, put it on my daily so we can go in and see it. Here as well, it has dropped below the 50%, which is at 112.60, 112.060. 618 is 111, 130. So it's in between. And so it could drop, and it could continue maybe to even, just as a B wave, come all the way down to 110.27. It could, and then still turn and put in the C wave up. And that C wave would likely be fitting for all what we've just been looking at. So because we could then go back over and run, we're just going to say we're going to go from there, and we're, oh, come on, using that, and go up to here and down to there. And so a C wave, what do we have? We've got, well, we've got that 1.382 and the 382, and they're both coming in at 120. We have a minimum of 118. We know we need to get above 116. So we have a 116.15, we have 118, and we have 120. And we got 119 in there too. So that is a pretty good zone. And it has to be 5 waves up. Okay, that's considering that this is already a 1, 2, 3, 4, 5. Very strange, but it's mostly plausible, I have to tell you. That we'll get back up here. Again, we're looking out. We may drop first before we get up there. Back out to that weekly, and let me take all these things, remove, and we can leave that one on. So that was the 10-year note. Looking over at the 5-year note, it's going to be pretty much the same. We already have it all in there. This would be if we continue to drop. If this was all we have, we're going to drop lower. We've already got that picture. Not a good one. We'll be coming way down. And we'd be looking for a larger 5. Now, that would be if that's all we get, and we're going to drop from here. Now, on this guy, let me remove that and go to that maximum. On Friday, we got almost back to 4%. Friday's close was 3.99. So it's about right there. 5-year notes. Again, we were at 0.25% back in September, August of 2020. And then we just came flying down in 5. Even if I go 1, 2, 3, 4, 5. And the only other way I can do this, folks, is 1, 2, 1, 2, 3, 4, 5, a 3. This is a 4. We come back down. And it's going to be a lot if we come back down. I think it would be a lot. Otherwise, now in the 5-year, it could. If I remove that, If it comes in, and I'm going to bring this back down, let's take it to the weekly. Same deal. I think I got an A, a B, and looks like we're going to get a C. Now, what do I put on? I want to look what that C wave can do for me. Do for this 5-year note. It's going to bring the yields back up, but it's going to bring the yields back down and the price of the bond or the treasury back up. And we need to get ourselves back above there. It should be also 5 waves, considering that if the lows are in. We still got more to go, and we're looking to a little bit of delay, and these numbers would change. But where the C wave would equal the A wave would be at 112.012. And then we can figure it out there. We have 113, 055, 113, 245, and 1.618 at 114. But I would think pretty much up in here. Nice, clean, ABC, C and A equal each other. That's pretty clean. And we got the weekly 50 at 112.130. That's the 5-year. So they're all pretty much in the same position. They may still have a little bit to go on the downside, but I'm not looking for major fireworks out of the bond right now. If we get that by any chance, for whatever reason, again, it's just going to signal that, well, we've just resumed the decline. And then again, maybe I still need to add one last 5th wave down to complete the initial 5 waves down before we get this larger B wave rally. It's all possible. Now, I know it sounds very wishy-washy, but again, tradable, number one. And number two, it's like it's the market, and the market's got to go on the input that it's receiving and the reality of it. We can't get around what needs to be done. And as the market moves, the market will move. And we all know that it can. So the 2-year note finished last week at 4.41. So almost back to 4.5%. So you can see that from the beginning of December, we closed out the month higher than where we began the month. And if we look at, this would be the month of December. So the high on the first was 103. So 4.25, now we're back down to 4.41. Maybe we have one more to go. Same deal we got going on here. A little bit more disastrous. But we have to take into consideration that we are constantly, that was what I meant, that would be 4.17. So we've already outdone where we came into the month at. In any case, I think the 2-year note also has the ability where it can come down, go below 101, 183, put in a new low, then rally. If it's going to rally from here, again, bringing this down, we'll look at the 3 or the weekly, 1, 2, 3, 4, 5. It's even nicer and more clear to me here in the 2-year note, and that we get A, and then a B. So maybe a little bit more on the B wave, and then we get the C wave. I think for sure once we're in C, we get above 103.233 or 223. And I think the 50 also comes into play there, but 382 is 105.006. Okay, interest rates done. Gold and silver, they continue to present challenges, but they're not running to the sky and they're not falling out of bed. So they're holding their own, waiting for their additional information or for what markets are perceiving is coming next. So again, I hold everything in check. I've not added any new labeling. I've not tried to label this because there's been a couple of problematic points. I'm waiting for the market to tell me. Things are still fairly lining up for the market to continue higher as it starts to build on a rally phase, which is starting again on a minor level, right? So minor 5th wave. So we're in a minor 5 going up, and it's off to a slow start, but somehow we might be getting like a 1 of 5. And now we pull back, or maybe this was the 105 in a pullback. I don't know. In any case, we should be at some point moving into a stronger rally where we begin to break higher and hold those highs. In fact, we put them in and then we build on them. We may pull back, but we continue to build. So over a weekly basis, we'll start to see higher highs, lower lows, until we start to reach up into target areas where we're seeing the fifth wave. Again, 100% wave 5, 100% of wave 3, sure. Again, looking at a commodity or a precious metal, it's that fifth wave that's explosive. So depending on where we see it, it's a fifth wave on a minor degree to finish a fifth wave on an intermediate degree. So we got a lot, and it could fly, and we could get pretty high. And there are a lot of reasons for gold to do that. One of them being the uncertainty in the markets and inflation. Here in silver, it truly also carries the same. It's not really breaking down. It's not really breaking higher. And that in and of itself is presenting a little bit more of a challenge to how do you want to trade it. I don't trade silver, and I have coin. You know, you pick up silver coins, but in this is all kind of interesting to me. So was this just the finish? And this was, that can't be, because that's a 3. So this and this, so did it finish here and a slight failure over that? So the wave 2, because you can look at it and you can see on our weekly chart, it's pretty much looking like 3s. And then we start to build from here. And it still looks like we're building in a 5. Again, we're not breaking down, we're not breaking up, but I'm expecting silver, if indeed it's going to move along with gold, to start going up in an intermediate wave 3. And that's of a primary third wave. So we should get biggest within the biggest within a 5-wave sequence. So I don't think it's unrealistic under this particular count. And again, I'm not hanging my hat on it saying absolutely 100%, but just it fits a longer term pattern, and it fits a longer term count as well, that I would look for silver to kind of continue to rally strongly, which does say a lot of things about what we can likely be expecting. And if we're really start to read between the lines as to what's happening with utilities, what's happening with the markets, where the money flow is kind of going within our equity markets, within a lot of different areas that are now becoming very popular. Individual stocks, not so much, or not as popular as investors investing in ETFs and funds of that nature. And so when you look to really hold, who really holds the biggest positions in our markets right now, you kind of have to go to who has most of the ETF market. And you're looking at BlackRock, State Street, and Vanguard as your primary 3, your big 3, your majorly big 3 have control and voting rights, for that matter, over, I think at last I read, it was like 96% of the S&P 500. That's a lot of control that sits in BlackRock, State Street, and Vanguard's ETFs. So BlackRock ETFs, GLD, SLV, God, don't get me started. They're all over the board. Everything has an ETF. Natural gas has this ultra long ETF and ultra short ETF. Crude has the same. Gold and silver have mutual funds and ETFs all over the board. So, folks, the risk that is being incorporated and into the hands of 3 very, very, very large position holders. So is there a reason for silver to suddenly break out or gold to suddenly break out? Yeah. When you're looking at investment, yeah. And how gold's going to react to uncertainty on a currency, on an interest rate, on a geopolitical situation, et cetera, what's going to retain value? The US dollar, the euro, the ruble, the yen, the pound, versus something that needs to back all those currencies, and that's gold. And unfortunately, right now, today, that doesn't exist. They're all fiat currencies. Yes, they all have gold sitting somewhere. The United States is not barren of gold, but we don't back our currency with it right now. So what we can start to put together is what happens when the gig is up. Now, I'm not sure when that's going to come, folks, so don't get me wrong. I'm not predicting that this is coming next year, but there's going to be something that's going to trigger it, and it's not going to be pretty. But right now, there are still trillions of dollars, as I discussed yesterday, about $6.1 trillion that freely needs homes on a very consistent basis. It's rolling around between the markets, and it gets placed from here to here to here to here. And it really is sitting in the hand of three very large ETF providers, fund managers. So silver can really rally. It just needs the catalyst, and it got it here. And I don't know what it'll be here, but I've just given you a list of where it could happen. Now, what else is this all going to affect? Well, of course, it's going to affect the dollar. Now, the dollar actually is sitting in a very critical juncture right now, because you can see we've had basically, I'm going to say 2 months, 3 months of down dollar. The dollar has kind of floated lower, whether that's been intervention, whether that's been central banks saying, no, you know what, we don't really need the dollars right now. They're dumping the dollars in favor of something else. Blah, blah, blah. But when the interest rates do determine that they're likely going to continue to rise, the dollar will become back in fashion, because if you're looking to buy US treasuries for the interest rate, you need dollars. So we'll see the euro sink and the dollar go up, and vice versa. Whoever's going to have the higher interest rate is where the currency is going to go. We may still have higher rates, but we'll have somebody else out there where it'll exceed. So right now, I have to really kind of keep going over this, and I'm fairly satisfied with how I've done it. Again, I'm not using color that's going to be significant of a cycle degree or any other type of a degree. I'm just labeling the chart and then the breakdown in between. Like this was an A, B, and I figured that was a C. And then we kind of went down in a B, and then we rallied again. And this rally, to me, I don't think it's the entire C wave. Now, there's a couple of things here that would really suggest that the dollar's going to go way higher. But right now, just over a month-to-month basis, I really believe that we're likely going to be rallying back, and we should be heading towards probably 122, where wave C is going to be equal to wave A. And then maybe go through this longer term period where the dollar drops and drops and drops in an additional 5 waves down. So that can happen as well. Now, mind you, this was our last catastrophe, but even in the middle of the catastrophe, we went soaring up, came down, went up, and came down. All right. Stimulus, stimulus, stimulus. Panic. 2009, panic killed the dollar. And then we watched the dollar go zipping up because we had to do something, et cetera, et cetera, et cetera. In any case, if we're looking at it, I still think the dollar needs to rally. What's going to kick it? A whole bunch of stuff. But I'd be looking for it to come up here. But I'm telling you right now, I don't really, it's down below the finishing point for wave A. And I'm like, okay, something's not really looking all that great. But I have to let it play out. If I bring this down and we start looking at it on the weekly chart, it's not as pretty. It could be A, B, 1, 2, 3, 4, 5. But we're back down there at the lows. So, but we keep holding it and then we rally back up. We hold it, we rally back up. So I'm going to actually give it to 102 before that. We're really going to be looking around and talking something more serious is happening in the dollar. But as we all know, there's a lot of reasons for a currency to fluctuate against other currencies. So, but right now, technically, I'm still giving it the ability where it's going to pull off this next rally. And if it really comes in strong, then it's not a 4. Then it's likely something much stronger. So in other words, that's the B. This is a 1, a 2, 3, 4, 5. When's the last time we saw that? Quite a while ago. Quite a while ago. So that's the name of all that tune. And this is where I'm going to keep it all and close it off for today. I thank you all for listening. Again, I don't have my long-term charts on the US dollar. I used to, but I don't have them anymore. So I'm reconstructing a lot, which is why this count that I'm using is just a pure Elliott count as to what degree or to where the dollar may or may not go. I still need to work that out, but I think on an Elliott basis, I'm going to go still with that. There's still upside to the dollar before we see a stronger dollar collapse. But the last 3 months, I would say, have been pretty strong. But now year end is over and we're off and starting new. Maybe we'll see something different. Okay. That's it for today. Thank you all for listening. And the next Eye of the Storm podcast will be next Saturday. And I will be making tomorrow, once Globex opens, I will make an Elliott Wave update, and that'll just be for the ES and the NQ. Thank you again. Have a great trading week.